In this video, we will explore project cost or job cost and how it relates to the company profitability and to the company accounting system. Construction is a high-risk business when compared to most other businesses. It is influenced by weather, labor, material shortages and deliveries, and many other outside factors. Managing the cost of a single project is critical to contributing to the overall profitability of a company. Often, in construction companies, employees don't understand, don't care, or never really thought about how the particular construction project that they are working on might influence the overall profitability of the company. It is very easy, especially in large companies working far, far away from the home office, to lose sight of an individual project's role in the overall profitability of a company and how much the project is really contributing to the financial health of the company. Generally, each project has a contract with either a fixed or an estimated dollar amount included to complete the work. In any event, there is likely an estimate developed to justify the bid and the contract amount. The contract amount will exactly reflect the accepted bid proposal, so that the dollars in the final estimate and in the final accepted bid proposal matches the contract amount. Once the project is awarded, the contractor will usually establish a project cost report to account for every dollar spent against the contract amount. The cost report will include labor, material, subcontractor, equipment, and miscellaneous project costs. The total estimate in the project cost report will exactly match the contract amount. There is a simple formula for determining the gross profitability of a project. That is, that the contract amount minus the total project cost. Total project cost would include all labor, material, subcontracts, equipment, so on. The contract amount minus the total project cost would equal the gross job or project profit. Of course, this formula assumes that the contractor collects all the payments due up to the contract amount and that he properly accounts for the project cost. Still, it is a fairly simple approach to determining gross job profit. So how does all this relate to the company accounting system? Sometimes it can be a bit overwhelming to look at a financial statement with all the different line items. However, it's a very simple way to view the income statement and begin to understand how it relates to project cost. If we look at an income statement, a very simple income statement, you will notice that it has the first line is job profit or revenues. Sometimes that's called sales. I like to look at it in construction as job or project revenue, all the money that has been taken in a given period of time, less job or project cost equals gross profit or gross income. And then there's another item, G&A expense, which is the office overhead, the salaried people that can't be charged to projects like clerical and accounting people and things like that. And once that's taken away from the gross profit, you're left with net profit. So if we look at the simple formula that we reviewed earlier, total contract amount minus the project cost equals the gross project profit, you will see that that kind of looks very similar to this section of the income statement. So assuming that you collect all of the dollars that are due to you as a contractor up to your contract amount, then the total contract amount would begin to equal the job revenues for a given period. So to make it simple, let's just assume in this example that all three projects that are listed on the left-hand side, projects 1, 2, and 3, started and ended within a given year, from between January the 1st and December the 31st, in this case of 2011. And let's assume that the total contract amount for each project was collected in payment from the owner or the client that we were doing business with. So if we collected all of our dollars due to us as the contractor up to the contract amount, those dollars would equal the total revenues for the year. So the total collected on all three projects for payment during that given year would equal the total project revenues. Consequently, the amounts left over after project cost was taken into account on all three projects would add together as project cost. The difference between the project cost for all three projects and the revenue, or the money taken in for all three projects, would equal gross income for the company. So it becomes obvious that any dollars incurred as project cost reduce the amount of profit on the project, assuming the project is lump sum, and directly impacts the bottom line of the company. So what happens on each project really does directly impact the gross profitability of a company. So in review, if we look at how an income statement compares to project cost, the total contract amount for a project represents the total amount of dollars that we hope to take in as a company as revenue for that project. So in any given fiscal period or fiscal year, the total amount of money taken in against a project becomes that project's revenue, and it directly relates to job revenues on the income statement. The project cost associated with that project for a particular period of time that coincides with the income statement directly relates to the job or project costs on the income statement. Therefore, the gross profit or the project profit directly relates to the gross profit on the income statement for any given period of time. So it's easy to see that individual projects and how effectively they're managed really do have an impact on the bottom line profitability of a company.